Hello everyone, welcome back to Mutual Understanding. It's the 5th of May 2026 and it's now 4:30 in the afternoon. Today I will walk you through the key financial terms that you'll encounter when dealing with two common types of credit facilities. That is, the bridge facilities and incremental facilities. These are instruments that you'll see in leverage acquisition financing, and understanding how they differ will make you far more effective when reviewing term sheets and facility agreements. I'll explain each concept in plain language and give you a sense of the typical ranges you would see in the market without getting into specific numbers. Question 1. What are bridge facilities and incremental facilities? An incremental facility is an add-on tranche to an existing credit agreement. Think of it as expanding the borrower's existing debt package on substantially similar terms. It is designed to be a long-term financing solution that sits alongside the original facilities. A bridge facilities, by contrast, is a temporary financing, a bridge to something else. It's meant to get you from point A to point B. Point A being needing money now for an acquisition, where point B being arranging permanent financing or achieving an exit. Bridge facilities are short-term by design, and they carry economic incentives to push the borrower to repay or refinance them quickly. Question 2. Let's take a look at the facility size. In the market, you typically see incremental facilities sized in the range of 1 to 3 times EBITDA, or capped at fixed dollar amounts, often somewhere between US dollars 150 million and 500 million, depending on the overall deal size. Bridge facilities are generally sized to cover a specific funding cap for the acquisition, and maybe somewhat smaller or similarly sized to incremental facilities. Often in the range of, at least in the Asian market, it's often in the range of $100 million to 300 million US dollars. The key difference is purpose-driven sizing. The incremental is sized for long-term capital structure, while the bridge is sized for immediate acquisition need with the expectation that it will be taken out. Thirdly, let's take a look at the margin and the interest rate. This is where things get interesting. The margin is the spread over the base rate, like SOFR or SOFR or EIBOR that the borrower pays. For incremental facilities, the margin is typically set at a modest premium over the existing facility, perhaps 25 to 75 basis points higher. So if an existing facility is priced at, say, 250 to 275 basis points, you might see the incremental at say, for example, it should be 25 to 75 basis points higher, so it should be around 285 or to 325 basis points. For bridge facilities, the starting margin is higher, still often 50 to 100 plus basis points above the incremental. In practice, you will see that the bridge margin starting in the range of 325 to 400 basis points. But here's the critical difference. Let's take a look at the margin ratchet mechanics. The margin ratchet is the mechanism that adjusts the interest rate over time, and this is where bridge and incremental facilities diverge fundamentally. For an incremental facility, the ratchet works like the existing deal usually, and is leveraged base. That means as the company deleverages, as it pays down the debts, as it grows EBITDA, the margin steps down, and you'll typically see 3 to 5 steps, ranging from the highest margin at peak leverage down to perhaps it could go down to as low as 225 basis points at low leverage. This rewards the borrower for improving its balance sheets. Whereas for a bridge facility, the ratchet works completely differently. It's usually time-based. That means whatever happens, whether or not the borrower pays down is there, whether it grows EBITDA, it's time-based. So it goes up regardless. It goes up, not down. The margin increases the longer the bridge remains outstanding. So that is the reason why we said there is a strong, the bridge facilities are built with incentives for the borrower to pay, to repay the outstanding principal or to refinance it quickly. So for that reason, a bridge facility, its ratchet, it works completely differently, and typically you will see steps up, and that goes up, not down, and the tip, you will see approximately steps up every 6 months, perhaps starting at 350 to 375 basis points, stepping up to 400 to 425 basis points at 6 months, and 450 to 400 to 75 at 12 months. So it's the economic stick that pushes the borrower to refinance quickly. On repayment structure, incremental facilities generally follow an amortizing repayment profile. That means the borrower makes regular scheduled repayments over the life of the facility. Typically, amortization begins 12 to 18 months after signing, giving the borrower breathing room post-acquisition. And the average life must generally be equal to or greater than the existing facilities. Bridge facilities are almost always repaid as a bullet at maturity. We rarely see bridge facilities being repaid with an amortization schedule. That means there are no scheduled repayments during the term, with the entire capital due on the final maturity date. This makes sense because the whole point is that the bridge will be refinanced or repaid from a specific source before maturity. Next, on opening leverage, when a lender assesses a deal, they look at leverage, the ratio of debt to earnings before income tax, depreciation and amortization. That's EBITDA. In an acquisition financing involving both a bridge and an incremental facility, the combined leverage is typically assessed together. You'd often see senior secured net leverage in the range of 4 times to 6 times, and total net leverage will be slightly higher. That total net leverage, including any subordinated debts, in the range of 5.5 times to 7.5 times. The point for lawyers to understand this is that the bridge facilities temporarily increases the leverage significantly, and the financial covenants and the structure are designed to bring that leverage back down over time. Next, on fees. Both the bridge facility and the incremental facilities typically carry an upfront fee, and this is sometimes called an original issue discount or OID, original issue discount or OID. In the market, you'll see these range from 1% to 2.5% of commitments. Incremental and bridge facilities often have similar upfront fees, and it's usually 1% to 2% each. For commitment fees, the fee paid on undrawn amounts are typically expressed as a percentage of the applicable margin, and a common range for commitment fees is usually 25% to 40% of margin. One important distinction is that bridge facilities do not often carry a prepayment premium, or sometimes we call it a non-call protection. What is non-call protection? We'll get to that later, but the lenders want the bridge facility to be repaid early, so there is no penalty for early prepayment. That's why we won't have non-call protection for bridge facilities. So incremental facilities, by contrast, often carry soft call protection, or we call it the break cost, the call protection, which is typically at 101 or 102, meaning a 1% to 2% premium for any voluntary prepayments during the first 6 to 12 months. Let me pause here and explain soft call protection with a concrete example, because this confuse many lawyers. Soft call at 101 simply means if the borrower wants to voluntarily repay the loan early during the protected period, it must pay a 1% premium on top of the principal amount being paid. So imagine you have a $100 million incremental facility with soft call protection at 101 for the first 12 months. If the borrower decides to repay it in full in month 8, it doesn't just pay back $100 million, because it has to pay $101 million, because that extra $1 million is the call premium. It's there to compensate the lenders for losing a profitable loan earlier than expected. And so if the soft call is at 102, that means the borrower would have to pay $102 million to retire the same $100 million loan. And so these call protections clauses would usually only apply to the first 6 months or the first 12 months. After this protected period expires, say it's a 12-month protection period, the borrower can repay freely at par, say for example just the $100 million with no premium. Think of it like an early termination fee on a mobile phone contract. The lender agreed to lend at attractive terms, expecting to earn interest for a fixed amount, a fixed period. If you cut that short, you pay a penalty. Bridge facilities don't have this because the entire economic structure is designed to encourage early repayment. Charging a premium for prepaying a bridge would be counterproductive. Next, on the financial covenants. Financial covenants are quantitative tests the borrower must periodically pass. For both the bridge facilities and the incremental facilities, you commonly see first the leverage ratio and the DSCR, which is the debt service coverage ratio, and also which is typically at least 1.2x. Asset cover, often requiring at least 150% coverage, and sometimes debt to equity and minimum equity tests. The key difference is in the leverage covenant ratios. For incremental facilities, you would see both senior secured leverage test, often around 5 times to 6 times, and a total net average leverage test. The total net leverage covenant is often set with acquisition headroom, meaning higher permitted leverage if a larger stake in the target is acquired. For example, it's 7 times if 80% of the target is acquired, and it's 7.5 times we're talking about leverage covenants. The leverage ratio would be required to be under 7.5 times if the borrower is acquiring more than 85% of the target. And let me unpack this with a simple illustration, because leverage and acquisition headroom sounds abstract until you see the numbers. First, the leverage ratio itself. If a company has an EBITDA of $100 million and a total net debt of $600 million, its total net leverage is 6 times, meaning it owes $6 for every $1 of annual earnings. The covenant says this ratio cannot exceed a certain ceiling. Now, why does this matter how much of the target you acquire? Think of it like buying a house. If you only buy 80% of a flat, you're a majority owner with less flexibility, and the lenders recognize that acquiring a larger stake gives the borrower more control over the target's cash flows, strategy, and eventual exit, which makes the debt safer. So they reward you with more headroom. In practice, this means if the borrower only acquires 80% or 85% of the target, the covenant might allow the total net leverage up to 7.7 times. But if it acquires 90% or more, lenders are more comfortable stretching the leverage ratio to 7.5 times because the borrower has greater control and can more reliably generate cash flows needed to service the debt. Conversely, if only 70% is acquired, lenders would insist on a tighter cap, perhaps 6.5 times, because the borrower has minority partners who may complicate decision making. So the headroom is simply the extra leverage room the lender gives you as a reward for taking the greater ownership and control. Whereas for bridge facilities, we've talked about the leverage ratio for incremental facilities. For bridge facilities, the covenants are often set at similar levels but inherently temporary. Once the bridge is repaid, the covenant levels revert to tight long-term levels under the main facilities. Covenants are typically tested semi-annually with delivery of financial statements, and there's usually no testing holiday post-closing, meaning there's no testing holiday post-closing. That means the borrower is usually tested from day one. Okay. Next, on the equity cure rights. An equity cure allows the sponsor or the shareholders to inject new equity or subordinated debts to remedy a covenant breach rather than triggering a default. This is a critical safety valve. For incremental facilities, the cure mechanics are generally, it's a safety valve for the borrowers. For incremental facilities, the cure mechanics are generally aligned with the existing deal. A typical structure allows around 4 cures over the life of the facility and is usually non-consecutive testing based, non-consecutive based, which means you cannot draw this equity cure card on the first year and draw the same card on the second year, on the next consecutive testing periods. With cure process applied to either increase the cash flow for debt service coverage ratio, or to reduce debt, or to increase EBITDA for leverage covenants. For bridge facilities, how do we do equity cure rights? As you could imagine, the cure rights for a bridge term is much more restricted, often limited to just one cure over the entire life of the facility. This is partly because the life of a bridge facility would be much shorter than a standard incremental facility. This reflects its short-term nature, and lenders expect temporary stress, but if you need cure more than once on a bridge, then something is fundamentally wrong. It's a huge red flag. In both cases, the cure typically cannot be used for asset covenant, and there's usually no cap on the cure amount, with the ability to pre-cure or over-cure. Next, on incremental incurrence conditions. This is the mechanism that governs how additional debts can be raised within the structure. Think of it as the permission slip for borrowing. Under the existing order, incremental facilities, usually incurrence conditions typically include a hard dollar cap. Often it's 150 million to 250 million per US dollars. Pro forma compliance with all financial covenants and requirements that leverage the average life and maturity be no shorter than the existing facilities. In other words, if your balance sheet looks good, then you're allowed to borrow more using a permission slip for more borrowing. Usually there's a cap, there's a fixed cap, a hard dollar cap with compliance with all financial covenants, etc. And it would usually be required that the average life and the maturity of such incremental incurrence, that extra facility, meaning facility, be no shorter than the existing facilities. Whereas for a bridge facility, it has a special feature. Its own incremental capacity is often specifically designated to allow an upsize for a defined purpose. Say, for example, acquiring minority shares or acquiring the remaining shares of the target. This may be capped at a total amount, with the upsize limited to a specific additional amount, and it must be offered pro rata to all lenders, and it typically must be exercised within a short window, say for example 6 months after the first utilization date. There is also typically a permitted refinancing concept, allowing the incremental facility to be increased specifically to refinance the bridge facility in full. This is the designed exit route for the bridge. Next, on the hedging requirements, the lenders would want to ensure that the borrower hedges its interest rate exposure. For especially in 2026, because of the geopolitical tension, because of world wars and trade wars, it's really difficult to we don't have a crystal ball to predict what would happen in the future. And it's especially for deals in recent years, you would see the requirements to hedge. So for incremental facilities, you typically see a requirement to hedge around 50% of the floating rate exposure within a specified period, often 90 days to 180 days of utilization. The hedging must usually be done with the lending syndicate on a pro rata basis. For the bridge facilities, there's typically no, at least I've never seen no compulsory hedging requirements. And this makes sense because the bridge facility itself, it is temporary. So requiring a borrower to enter into a hedge for a 12 to 18 months facility that should be refinanced within 6 months would be commercially impractical. If the borrower chooses to hedge its interest rates exposure, it should still typically be done on a pro rata basis with the existing lender syndicate. So next, let me just break this down with one quick simple example, because hedging interest rates exposure sounds intimidating, but the concept is straightforward. Imagine you borrow $200 million under an incremental facility. It's at a floating rate. That means, say for example, it's SOFR plus 300 basis points. The SOFR today might be 4%. So the total interest cost is 7%. But the SOFR interest is a floating rate. It moves. So if the SOFR rises to 6% next year, your total cost jumps up to 9%, and suddenly you are paying $4 million more per year in interest than you initially budgeted for. And that's the interest rate risk. Hedging eliminates or reduces that risk. In practice, hedging 50% of floating rate exposure means out of your $200 million loan, you must enter into an interest rate swap or a cap covering at least $100 million. And interest rate swap easily it converts your floating rate into a fixed rate on that portion. So you might agree with one of the banks that for the next 3 years you pay a fixed 5% on the $100 million regardless of where the SOFR goes. If SOFR spikes to 6%, you are protected on half your loan because you've locked in 5%. And if SOFR drops to 3%, you still pay 5% on that hedged portion. But that's trade-off. That's similar to when you purchase insurance. And there's a trade-off, but then if things go south, you get protection. So if SOFR drops to 3%, you still pay that 5% on the hedged portion, and that's the trade-off. And think of it like fixing your mortgage rate on half of your home loan while leaving the other half variable. Now, why with the lending syndicate on a pro rata basis? This means you cannot simply go to an outside bank or a third-party bank to arrange your hedge. You must hedge with the same banks that lend you the money, and each lender gets a share of the hedging business proportion to their share of the loan. If Bank A provided 40% of the loan, Bank A gets 40% of the hedge. If Bank B provided 20% of the loan, it gets 20% of the hedge. This is partly about fairness, and hedging is profitable business for banks, it's particularly about alignment, because a lender who also provides the hedge has a complete picture of the borrower's risk profile. On the other hand, for bridge facilities, does it have a hedging requirement? Usually it's a no. Typically there's no compulsory hedging requirement for bridge facilities. And this makes sense because the facility is temporary, like we've discussed earlier, so requiring a borrower to enter into a hedge for a 12 to 18 month facility should be refinanced within 6 months will be impractical. It's unnecessary. However, if the borrower does choose to hedge, it was still typically with the lenders on a pro rata basis. Next, that's our second last item on the list, financial information and reporting. Both the bridge facility and the incremental facility typically require the same reporting package: annual financials or semi-annual financials, annual budgets, compliance certificates with each reporting period. One distinction to note is that an incremental facility may require additional property or asset valuation, such as a core target real estate evaluation by a specified date ahead of the bridge maturity, because the lenders need to understand and need to figure out the asset values for the refinancing analysis. So bridge facilities typically just require valuations at the same time as the main facilities. Lastly, let's talk about MFN, Most Favored Nation Protection. What is MFN? MFN protects protection. It ensures that if a new tranche is priced higher, then the existing lenders get the benefits. In both incremental and bridge contexts, you would often see an implicit MFN. If the incremental must be on the same terms as the existing facilities, then effectively any improved economics, any improved financial governance, as more favorable to lenders, flow through to all lenders. Let me explain this with a concrete example, because MFN is one of the terms that sounds simple, but it has a real commercial bite. Imagine a lender who agreed to lend $200 million under an original facility at a margin of 300 basis points. 6 months later, the borrower wants to raise an additional $100 million incremental facility, but the market has moved, and the new lenders would only come in at 330 basis points. Without the MFN, the most favorable nation protection, you'd be stuck earning 300 basis points, because that's what the old facility says, and that's what you're locked in the signed existing facility, right? While the lenders earn 350 basis points on, but it's essentially the same credit risks with the same security package, you'd feel shortchanged, and rightly so. So the MFN protection fixes this with an MFN clause. If the new tranche is priced higher, say for example 350 basis points in our example, your existing margin automatically ratchets up to match, or at least it gets closer. Think of it like a price match guarantee at the supermarkets. If the same product goes on sale at a better price elsewhere, then the store matches the price for you. The product here is the credit risk, and the price here is the margin. Now, there are two flavors of MFN you'd encounter. The first is implicit MFN, and the second is the explicit MFN. Let's talk about the implicit MFN, which is the simpler, more conservative approach. Here, the structure says simply requires that any new incremental tranche must be quote-unquote on the same terms as the existing facilities. In other words, the new tranche cannot be priced better, higher than what the original lenders are earning that they have agreed to. Problem solved by preventing the disparity from arising in the first place. The second type of MFN is explicit MFN, which you see in more aggressive sponsor-led deals. This is more nuanced. It typically allows the new tranche to be priced higher, but the difference exceeds a specified cushion. Say, for example, it typically allows the new tranche to be priced higher, to be priced better, but if the difference exceeds a specified cushion, say for example 50 basis points, then the existing lender's margin is bumped up to narrow the gap. So, for example, let's use our old example. If the cushion is 50 basis points and the new tranche, the original tranche is 30 basis points, and the new tranche is 350 basis points, then the existing lender would stay at 300 basis points because the 50-point difference is within the allowed cushion. But if the new tranche came in at 375 basis points, in this case, that would be a 75 basis point difference. Then the existing margin would be raised to 325 points, and because there is a large difference. So explicit MFNs often is included. It often includes a sunset, meaning the protection expires after set period. Say for example, it usually lasts 6 months to 12 months after closing. After the sunset period, borrower can raise new tranches at any price without triggering the ratchet. This gives lender protection during the critically early period, while giving the borrowers the flexibility and the freedom to negotiate better terms for the borrower once the credit has seasoned. Okay, so that's all for today. As a quick summary, the incremental facility, the purpose-wise, the incremental facility is designed as a long-term addition to capital structure, whereas the bridge facility is more of a temporary gap financing. And that's the reason why for a bridge facility, it usually has a higher premium compared to incremental facility. And for bridge facility, it can charge 75 bips or even 150 bips higher than the existing financing, whereas for incremental facility, it's usually just 25% to 75% bips higher than the existing financing. In terms of the leverage ratchet, the interest rate, the leverage ratchet, for incremental facility, it's usually leverage based. It means as the borrower pays down the debt as they deleverage, the leverage ratio requirement steps down. Unlike the bridge facility, where it's time based, and the longer the bridge facility is outstanding, the higher the interest rate will be incurred. Whereas for incremental facility, in terms of repayment, incremental facilities usually has a amortized schedule with scheduled repayments, whereas for bridge facilities is all due at maturity with a bullet repayment method. For incremental facility, there will be prepayment penalty, and usually we call it the soft call for the first 6 to 12 months. You might have to pay. It's usually 102, 101 soft call protection for the lenders, whereas for the bridge facilities, there is none soft call or non-call protection because the lenders want you to repay early. For equity cures, there are more equity cures for an incremental facility than a bridge facility. Usually for an incremental facility, that would be free to fill for equity cures, whereas for the bridge facilities, there will only usually be one cure over life. If the lenders allow the borrower to cure the bridge facility more than once over a short life of 6 months or 12 months, then it's a huge red flag. On hedging, the incremental facility is usually compulsory. It's often 50% of the hedging rate exposure for the first 90 to 180 days, whereas for bridge facilities, there are usually no compulsory hedging requirements. That's all for today. And so, all in all, the fundamental principle is this: the incremental facilities behave like the existing debt, and they're designed to stay. It's designed with long-term planning in mind, whereas the bridge facilities are designed to be a quick temporary tool. It's designed to leave, and every economic term incentivizes their early repayment. So, that's all for today. Thank you for listening. I'll see you in the next one. Bye.